I would like to invite to the podium Walter Maciel. Walter is a managing partner and responsible for business development and investor relations for Quest Investments, a very successful fund management firm in Brazil. And Walter has about 20 years experience in financial markets, local financial markets, has worked for more than 10 years with Banco Garantia, a local investment bank. So I would like to welcome Walter here so he can introduce the other speakers for the panel. Thanks.
Well, good day to everyone. I'd like to thank Therapin for inviting us to be here. And would like to introduce the members, the participants of this panel. Here we have Thomas Souza. Thomas is a founding partner of AguasClaras Investimentos, an equity-only fund with 150 reais under management, 150 million reais under management. Rodrigo Bresser is the founding partner of Bresser Asset Management, a company with 250 million reais under management, 100 million in hedge funds and 150 million in equity funds, with focus on long-only and long-short funds, offshore and onshore. And lastly, Zylberberg is a senior partner responsible for the asset management group at G5 Advisors, a corporate advisory asset management and private wealth management founded in 2007 and focused in Brazil. Today, the AUM is 250 million reais, roughly $160 million. I'd like to start the panel. The panel is regarding from emerging to established, taking our fund to the next level, asking the participants, what's required to take your fund to the next stage? Thomas, would you like to start?
Sure. First of all, good afternoon, everyone. Thank you, Therapin, for the opportunity to be here today. I think, assuming that you have a sound track record, of course, all you need today to achieve the next level is patience, patience, and patience. No, seriously, I think nowadays, after the financial crisis of 2008, it is most important today for the fund to have a very sound operational and risk management structure in place so that it will give the investor the credibility necessary for the investor to be 100% sure that it is investing in a sound place. And I think also, after 2008, the funds today require a very strong and committed marketing effort. I think investors today are very difficult to establish a long-term relationship with. It's taking more time, and a committed marketing team will help alleviate the time the manager spends on the road selling the fund and marketing the fund. So today, I think having a very strong and committed marketing effort is vital for the long-term success of any fund management company in Brazil.
Rodrigo.
Okay, I'm Rodrigo. Okay, good afternoon now. Eh? Well, I think the answer doesn't go too much different from what Thomas said. I would focus first on performance. Performance is, I think, is the most important thing to start in the beginning phase and in the second phase. I have seen funds going in terms of asset managers, in terms of size, companies growing very, very quickly with performance. So a consistent and outstanding performance has to be consistent and has to be outstanding. That's one thing that we always focus, and we are focused every day more. Second thing is transparency. Also, I think it's very important to be transparent. I think this is especially after 2008. The other thing is goes together, good relationship with clients. In my good customer service, I'd say, good business ladder and helping them to solve their problems, to understand and being fast to answer their questions and all that. In our case, our client base is very much focused on very high net worth individuals which I think it's something good, because and has a lot of investors, doesn't have a lot of concentration. So this is also having other clients note that you are not too much concentrated in one or a very few investors. It's something that gives also some credibility to the fund. Another thing I'd like to focus is commercial side. I think that's crucial. That's something that we are investing more. Operations, have a strong operation, trading, controlling, compliance, and risk management. All this is something that we have invested for the next level that we plan to achieve. And we have invested very strongly especially in the last 2 years. And I also think it's important, another thing, is to have a strong partnership. I am the founder and the main partner, and we have other partners in the team, and we are adding more people and more partners. So a strong partnership relationship keeps a bond and people very motivated.
Good afternoon to everybody. Being the last to speak, it's difficult to say something new, but I'll try to say something different. Assuming that the fund has a good and solid track record, it's very important that also keeping costs in check, that it has a good investment infrastructure even before investors come in. Just because especially when you deal with emerging markets, I think investors want to see not just the track record, although the track record is very important, but also that operation and that the fund offering memoranda, it's clear, and the team it's prepared, and that all the questions can be rightly answered, and all the ticks are checked. Also, I think it's very very important to have a very open and frequent communication with investors, especially because you are far from them if you're dealing with offshore investors. And many times they don't understand very well what's happening in the country, and they feel more insecure. So if you are open to give this time commitment, it helps a lot. And also have a very strict adherence to its investment philosophy. I think for investors, worse than losing money, it's losing money or even making money in a way that you are not supposed to, that it may be a killing.
Thank you. In our experience in Quest, I think is almost the same. Not only having a consistent long-term track record, but a solid corporate governance and a very clear and solid investment process are key to getting the trust from clients. What do you see? Do you see that there are advantages as being a large-scale asset manager versus a smaller fund? And what are the clear advantages that do you see? Let's start with André this time.
Thank you. Being large has only advantages. Assuming that there is enough liquidity in the market and your strategy is scalable, there's only advantages. It's easier to attract and retain talented people. It's easier to have all the infrastructure in place. Investors also, they feel more confident that they are not the only ones there. But also it's important that even before opening the asset management firm, in your game plan, it's important that you try to bring down your costs by pooling together your resources. So in our case, we only have equities. We have long only and long short. So we share just one research team. Sales team is the same. Operations and risk control is the same. So we try to pull things together at the same time, also minimizing risk.
Rodrigo.
Okay. Well, let's talk about the advantage, of course, and which the question and maybe some disadvantages also. Well, I think what André mentioned, I think in terms of you can have a higher profitability being larger, and it's easy to attract. You can have a better quality team and more motivated instead of having 2 or 3 good people or 5 top people in the company. You can have 10 people. You can have more outstanding quality in all areas of the company. So you can do more. You can have more funds. You can diversify. There's a lot of advantage of having that. If you don't have as much, you have to focus your effort more in one investment process, in one strategy, and all that. So I think it's that. It's the team, quality and motivation of the team. Another advantage, I think, it's visibility. We have seen the higher in terms of fund you are, the more business you can get. Not only in terms of clients, it's easier for clients to invest, but also in terms of opportunities. If there's somebody that wants to sell a company or sell a big block, they're probably going to talk to you first instead of going to the market to see if they can do a kind of a private deal. So that would be another advantage. Sometimes we see that. I'd say that there is some small disadvantage. No? When you become too big, you have a problem in terms of the opportunities you can have. We're talking here, most investors are in the equity markets, where we have seen more funds recently. And basically, if you are a big fund, a few $1 billion, if you want to invest 10% of an equity long fund in one company, you are talking about 200 million. And sometimes you reduce significantly the amount of companies you can invest. Without making a lot of calculation, I would say that today we have 250 companies that we could invest. If you have very large funds, this universe reduces significantly, maybe to 50 companies if you want to have liquidity. If you want to stay in the large companies. If you want to go, well, I'm big, but I want to go to the small companies. Then you have another kind of problems, no? Because either you have to buy a small company and be married to the company, so you cannot make any mistake. If the company change, the market change, anything you cannot sell. Or when you buy, it's probably going to be difficult to buy. You're going to force the market, influence price significant, and when you sell, it's also difficult. So so when you sell, you're also going to put pressure on the company. It's going to be very difficult for you. You're going to have to be really long term, when sometimes you could be more flexible. So I think there's also some disadvantage. Another thing that can be a disadvantage of being too large is it depends on how is your investor base. If you're large but you have a lot of investor base that are very focused on short-term performance, then it becomes a problem. I'd say if somebody follows the real estate market here, it's the difference between a large company, a large real estate company, and a small real estate company. Analogies are always dangerous, but I would make this one very quickly. If you're too large, you have pressure to launch new projects all the time, to meet the guidance and all that, and you don't focus as much as in the profitability of the projects. If you're smaller and don't have such a large operational structure in the company, you are able to select more the projects and able to let pass some opportunities if you think the market's not good. Thank you.
Thomas.
I don't have much to add on this topic. I think a lot has been said. I would add the following, though. I think the major advantage of being large today is that, again, after 2008, I think most of the money has gone to the larger, more established funds because the investor doesn't want to spend or doesn't have the human capital to spend a lot of time looking at the smaller funds around. So I think that in attracting capital after 2008, that has been a major advantage of the larger and established funds. But I think the major advantage of being small is that you're nimble, you're quicker, you might react faster to investment ideas. You might, like Rodrigo said, position yourself in a more efficient way. So I think, and there's only upside if you're small. So I think, I think being small is still something that is very attractive for the investor. that does his work in terms of due diligence. I think there are a lot of small funds here in Brazil that have a very good, solid standing in terms of operations, corporate governance, like Maciel said, and deserve to be on a target, on the radar screen. But they're not, because the investor comes here, he only wants to meet the large funds, and so be it. But I think that will change with time, so that's it.
Well, in Quest we have 2 billion reais on the management spread in 3 different strategies. And we started with macro funds, and we used the growth of the company to be able to invest in other strategies. So we came from 6 years ago only macro, and today we have 80% of our AUM on equity funds, both long only and long short. And now we are investing again on macro. This diversification leaves the company more prepared to endure through crisis and to experience different periods of profitability in different products. As well as when you achieve a larger scale, then you're able to invest, and not only to attract but to keep qualified people at your research team, portfolio management, and even on systems, technology, etc. The next question is, how do you see the importance of being a local manager? Rodrigo, I think we'll start with you this time.
Okay, I'll let Rodrigo start.
Okay. So it's the importance of being earnest or local on a micro level and a macro level. Starts with a micro level. I mean, in the company level. Well, basically, being here, we talk in the company on a daily basis. I have a meeting today at 5 o'clock in the company with the director. I have a meeting on Friday in the company. We have lunch almost every day, breakfast almost every day. So our research team is visiting companies all the time. That's a big advantage. If you are based on New York or based in someplace else, what you can do is plan a trip and visit some companies once a month or once every 2 or 3 months. So, I mean, being local, it's really in terms of being in contact with the company. You have some doubt, you take the phone, you are in the same time zone. So there's a lot of advantages in terms of contact with the company being local. Then there's many other things related to that. We meet people at the restaurants. Meet people at parties, meet people at the club. We meet other investors. I meet Thomas sometimes at lunchtime. Meet some other people at lunchtime also. So, and it's always the focus on everybody that is besides you. When you are driving, you are a consumer also. Your family is a consumer, so you are able to understand. When we're talking about real estate companies, everybody has an experience and know which companies are good, which companies are bad, which ones that have problems. If you go to a lawyer, the lawyer has a client that also knows about the companies, knows which ones have liabilities. So there's a lot of rumors and information that comes to you all the time from all different sources that helps you to understand better the case. And you have the newspapers, you see the companies all the times, and you see what companies says, and you see what the companies advertise. One thing I like to go about I used to like to go to New York is to read the Wall Street Journal and know what was the advertisements. On a macro level, it's also a little bit the same things. You read the newspapers all the day. If you're in New York, you're going to read the Wall Street Journal. If you're here, you're going to read the Valor. So I think it makes a lot of difference. And here we know the people who are in the government are people that were in companies, in banks, in universities. So it's much easier to understand what they think and to be faster in terms of the trends. I focus on that.
Just adding to what Rodrigo said, I think that depending on how developed the country is, or how how much the story has been played out. Sometimes if you are trading from a distance, it can be an advantage. You're more detached. You don't really, you're not concerned about the noise. So I would say that maybe in the 90s, it was fair to say that it was better if you were not based in Brazil, because you wouldn't pay much attention to the day-to-day noise. And you see the big wave that was coming to emerging markets and everything that had to do with interest rates coming down in the world, inflation. But now Brazil is definitely not at that stage. Brazil has been discovered. The China play has been already played out. The idea of just buying EWZ or MSCI Brazil and trying to explore the lowering of the country risk has already happened. So we think that most of the trends, most of the interesting trends are done at the sectoral micro level. And it's much easier to spot them if you're here, if you can talk to the companies, if you can see what's happening with new trends, new companies being going to the market, assessing the competitive landscape. And it's very tough to do that when you are from a distance, especially because we think that the most exciting stories have to do with Brazil and not to do with commodities. And so you need to talk to the management, you need to visit the companies. And you can only do that if you're local.
Thomas?
Being last is always very tough. But I would add that being local, I think, is critical importance. I worked on the sell side at Merrill Lynch for 10 years. And I think, similar to the sell side, I think the research shops that have been successful in Brazil are the ones that are local. And in asset management, it shouldn't be different. I think being local gives you a research edge and a better and deeper knowledge of the markets than being in New York or in London or anywhere else. In addition, I think it allows you to be better positioned to benefit from market dislocations that occur in terms of pricing, where you can build stronger conviction very quickly by, like Rodrigo said, visiting the company 1 hour after something happens if you have that capability. In addition, I think being local for the foreign investor is important because the local management shops, they are under the scrutiny of the CVM and ANBIMA, which is a very sound and strong regulatory body, which minimizes, I think, the risk of wrongdoing and blow-ups and fraud, like you see in other places in the world. So I think that's also a major positive of being local. And finally, I think from a business standpoint, the fact that you can diversify your investor base, have other products, related products, and therefore diversify your revenue stream and sustain your long-term the business in a profitable and adequate manner. So I think being local makes all the difference.
Thank you. Lastly, Thomas, you again. The rise of M&A activity, asset management globally and in Brazil specifically, how do you see that?
Well, globally, I don't have much to add, but I think in Brazil specifically, I think there is a very visible trend going on. Brazil today has around 400 managers with around 10,000 funds, and I think $1 trillion in assets. But if you look at the composition of this, it's mostly in fixed income and similar products or related products. In equities, for example, where we are, there is a very small number of shops and a very small number of human capital around. And as we go forward, I think, assuming, of course, that real interest rates come down in Brazil, which is a big if, but if that happens, I think M&A will happen very strongly because fixed income shops, and I think your example is very interesting. You went from being a macro fund to being an equity fund, and you had to probably invest in equity human capital to do that. So I think that's going to happen because you're going to continue to see fixed income asset managers invest in equity shops, and therefore you're going to see M&A in that direction. You're also going to see foreign investors, asset managers come down to Brazil. We have been hearing a lot of that happening and a lot of studying and analysis going on. So I think this will also happen in the next few years. I think the valuation metrics that will be used are still not known. I mean, the metrics are known, but there is no rule of thumb. You're going to see every kind of situation. It can be a share exchange. You can see percent of AUM, a percent or a multiple of operating income or net income. But the valuation metrics will certainly depend on how quickly and how profitably the strategy being purchased can perform, of course, going forward.
I think I can point out to you an interesting example that happened to us. We decided last year, back in September, to sell 50% of our firm, which Walter mentioned is it's a boutique which has asset management, private wealth management, and M&A. We sold 50% of it to Evercore. We did it not for the price, because as a matter of fact, what they're paying is it's a multiple of our earnings stream for the next 3 years. But because we thought that would allow us to grow faster. And also we try to strike a balance in the sense that the day-to-day management is all done by us, and we created a committee to discuss the more strategic decisions. And they were very happy in doing that, even though we were sort of firm at an early stage, because they were really excited about Brazil and they didn't have any presence here.
Well, thank you. And if you have some questions, we'll be happy to answer.
You talked about the importance of being local, and I'm interested for the end investor in communicating marketing and investor relations. How important is it to be able to communicate effectively in Portuguese? And maybe there's a difference in written materials, quarterly letters versus in person. But if I send somebody down from New York who's not a native speaker, does that do me any good, or do I really need to find somebody local?
No, I think, of course, you have to assume that you get some English-speaking talent in the shops that you're visiting. I think, and that's mostly the case. So I wouldn't see any trouble whatsoever if you visited any of us in having a language barrier. I think all the material that is being published from a marketing standpoint is both in English and in Portuguese. So I think the language barrier for me is not an issue, but I'm not sure.
Well, at Quest we have 24 people directly in the investment side of the company, and they all speak English, which is true for investor relations, for the risk manager, and probably 50% of our back office and administration. So I believe that seldom will be the case where you come here and you won't find an English-speaking counterpart.
Yeah, it's the same. I think most, including that most of us here, it's our case. In our case, our offshore fund started first, and it's a little bit bigger than the local fund, actually. And so everybody in the company is usually to talk with English. We visit some clients offshore, and we talk with the suppliers, with the funds that provide service for us offshore. We have material written in English. We have a site in English and all that.
I disagree a little bit. I think the language is it's a barrier. Not the language per se, but what comes together with the language: culture, behavior. No, sometimes you speak in English with, let's say, a Russian investor. So English is the common language. We are just using that. But a Russian investor thinks totally different than a U.S. investor. So it has some difference in behavior that comes with trust. And many times I see that local funds that have an offshore salesperson, many times they do better because you see that there is a easier bond that's made between the investor and the sort of the person who sort of does this, builds the bridge. But I think it's less the language and more the difference in culture.
Well, thank you then. We'll all have a good lunch.